Okay, good morning, Trading View. Have my microphone pulled up today. Wife is still across the hall sleeping, so I don't want to wake her up. I'm guessing she wouldn't be too terribly happy with that. So I made some adjustments yesterday that I just want to share. Not for a trade idea, but more so for an educational purpose, and I want to share that with you. So check this out. Yesterday, I was marking up the charts with Stephanie, my friend. She also goes by, actually, I'm not going to mention it because I'm not sure how that plays into the rules on TradingView, so I'm not even going to poke the bear. However, I was marking up the charts, and if you look at yesterday's markup, I had these two patterns right here, okay? And we also had a pattern down here, more like a wedge, before we pushed up. Now, I told you the day before I wasn't going to have my weekly flag going all the way through, and I explained why I wasn't going to have my weekly flag come all the way through here. Said I'm leaving it back here. And if you didn't catch yesterday's trading markup, I do highly suggest that you go and watch it. There's a ton of value inside of it. There we go. There is a ton of value inside of yesterday's markup. But I made some adjustments yesterday, and I had to share them because instead of just stopping at this markup, okay, and it wasn't even just this markup, because I had my flag evolved to here, like this. Now, it still played out in my favor, but I want to show you the cleaner version of this markup, because that's still clean, but it didn't leave it open for interpretation like it's about to by me evolving what you're about to see. So on the top of trend lines, you can have a trend line on the top like this. Still valid. I'm not going to disagree with that, but sometimes some parts of the trend line hold better than others. Like the top of the trend line may look better than the bottom of the trend line, and you ask yourself, okay, well, which trend line am I supposed to keep in this instance? Really, it's whatever trend line is showing you the most information. So that's what we're gonna look at today. Is I could have had a trend line like this, but I don't like how it reaches all the way back. So instead, I just brought it up to here, and we're gonna bring it up till it touches right there. 1, 2. This area where price wicked below, closed back above, wicked down, and then moved off. And we had a potential third touch here. And I think I ended up cleaning it up afterwards. So this is kind of the trend line I was left with, and I don't like how the top of this trend line it's not that it's not valid, but I don't like the way it looks, as nitpicky as that is. And I'll tell you how I even spotted the trend line is I was on the 4-hour time frame and I inverted my chart. Now for me, inverting my chart, I can just see price so much better. Just because like when I started, I was in a bearish market. So I learned how to trade on a bearish market, and that's something a lot of traders don't take into consideration is you start off trading on a bullish market. Maybe for instance, after 2020, maybe 2022 to 2024, you were trading in a bullish market. For instance, when I started trading, it was like 2019, 2020, 2021. I was very much in a bearish market. During COVID and stuff, there's a lot of retracements in price. So I learned how to trade in a bearish market. That was a majority of the setups that I saw. So what I did is I inverted my chart, and I was looking at these areas down here. This area price, boom, and this area of price had gotten hit. So I was looking to see how price reacted now down here. So what I did is at first, like I said, I had my trend line kind of drawn up like this. And it didn't leave a lot of room for interpretation because, for instance, I had seen a break below that trend line, come up, make a flag like this for me to look lower. And this is just a reference. The flag could have been on a lower time frame in this area. But I would have been looking more so for price to retrace there. So instead of having this large flag, I ended up taking it, and I immediately saw the flag here. And I could tighten up my flag, and then I saw the flag here. And then I saw us coming down into this area. Now, price doesn't have to hit here. Okay. So now let me invert our chart back. Let's replay where we were looking last night. So this is what we were looking at last night. On the lower time frame here. I'm not even sure if I can go 5. Yeah, perfect. So I saw this wedge forming pretty much at the top of this area. Right here. And I wanted to see how price played above this area or below this area. So let's fast forward it. Price wicks above and immediately closes back below and is rejecting off of this. So now that we've seen the rejection off of this, it pushed above, and where it should have tested the box, it broke through our support zone, pushed back up, tested. Price now starting to form this descending channel. Okay. So what I'm looking for isn't trying to catch an entry off of this descending channel. I have this zone marked up here, which was the bottom of this ascending wedge. So I had this liquidity zone that I was watching because I wanted to see if price tested, then broke back above. I just got a new mouse, and it has one of those little like rolling balls on the side of it, and I'm not sure how I feel about it yet. It was a good idea in retrospect, but I'm still getting used to drawing with it. So that's why you'll see me draw these crooked lines. So now I'm having to actually like take my path indicator. So look for price to reject off of this, come back up above, and then we would look for price to come up and tag these highs right here. That would have been our long position. After seeing it clearly break this high like that. And let me just use a line. Yeah, it's clearly breaking above this high, then breaking back in, forming some type of channel here, and then taking it higher. That was our long position. I was looking to see how price reacted off of this area. Okay, but if price didn't reject off that area, well, then I'm looking for price to break clearly below and give us some indication that it wants to go lower. So let's fast forward again. So now we get a rejection off of, we get a clear break below, and let's rewind it to here. And let's slow this thing down to 3 times. Let's just go by bar by bar. So we get a clear break below on this candle. We get a second clear break below. And now once I see this wick down here, I already have my targets marked up down here on the bottom side. So let me grab this. This is my first target, and this was the second target we had discussed, which also simultaneously lines up with our trend line. I'm not going to explain how I got those targets, but those were the targets that we had. Now, let's go ahead and bar by bar. So it's like, okay, where did you get in then? Well, the moment that I saw it come up here to this rejection, because I'm dropping down on the 1 minute time frame, and I can't do that on a bar replay. I'm seeing a huge descending channel right here. So I'm like, okay, I'm willing to take this trade just inside of this structure, stop loss inside of this liquidity zone, and stop loss behind this channel, and stop loss back above this little area, or this last lower high there. So 1 piece of structure, 2 pieces of structure, 3 pieces of structure, 4 pieces of structure. So that's high enough for confluence now for me to enter the position. So we enter the position, we immediately get a push down, another push down, and now price starts breaking lower. And we get some pullback. And if you're trailing your stop loss, so for us here in this situation, I'm not just going to move my trade. People make this mistake all the time, where you don't trail your stop loss, where I could put it behind this piece of structure. But what you're doing is you're not taking away from your profits, you're minimizing your risk on the table, because you're like, okay, well, how far in profit am I? Well, right there, I'm only 1% in profit, and I'm looking for a 3.5% to a 4% take profit. Well, if I understand that I'm looking for 3%, 4% take profit, then why would I want to mess with the take profit area by taking my take profit here, trailing it for 23 pips for price just a wick back above, take me out of the trade, and then continue to the downside, when instead of having my full risk on the table, which was like really just behind this, it was like 29, 30 pip stop loss. I take my stop loss and I just move it down to break even on the trade. And really not even break even. I just reduce it down to like 8 pips. And it goes from, it's still the same trade. I still entered in at the same lot size, but the risk factor significantly increased. Now I'm only risking 8 times 3, 27. Like a third of like a percentage, which is crazy. So I'm only risking 8 pips now on this trade. And some people, yeah, you can move it to break even, but for the style of trading we have, yes, it probably would have been the smarter play, but I'm just telling you how we manage the positions. So anyways, we're managing position here. Let's grab this. And fast forward. Price now comes back up. 1, 2, 3. You could have been looking for another position. I was asleep. Stop loss back above this area for a stack in. Looking for a minimum target here of 2.5 or another target there at 4%. And you could even just manage your stop loss back behind the structure since it's the third touch. And we fast forward again. Boom. Take profits hit. You had a 5.82% trade here with a 20 pip stop loss, and this originally with stop loss back behind. This area was at a 4% trade. So you have 9% off of a 175 pip move by being able to manage your stop loss and capitalize on these trades. Price rejects off of our trend line, and let's just clear off our select bar now. And that's where price is currently, just floating above our trend line. So what we could do is now wait to see how price wants to break back below these areas. I'm putting it just below this liquidity zone that we rejected off of. I'd have it back behind this liquidity zone and behind that piece of structure, and we'd have to tighten our stop loss there so we could get in for another position if price wants to break to the downside. And if it breaks to the downside, it's just bombs away, because you're looking for a minimum of 280 to another 300 points. And we all know on gold that's completely feasible. But those are those two trades. I just want to show you thought process and how we entered, some adjustments that I made by being able to just simply invert my chart. I see the market better this way, so that's just how I was looking at the market. So yeah, hopefully y'all have a great trading day. Get something from this lesson. There's a lot of value inside of this one as well. We cover trades like this all the time. We're not about just flashing profits. Anyone can come on here, and what you don't see behind the scenes is you'll have some trader come onto YouTube or one of these spaces, and they're showing you how I made 28,000 in a day, how I made 40,000 in a day. And it's nothing against them, but you got to understand, okay, what were they willing to risk to have that perceived profit? And what you'll see is like, yeah, these traders can maybe have a $20,000 day, but you don't see the multiple blown accounts behind the picture, or you don't see the drawdown that they go through, or you don't see the losses that they take all the time. And with just us showing you the pips, you can't fake pips. Pips, the reason we're so focused on the pip amount is because pips can be replicated. A dollar amount that someone gets off of a trade cannot be replicated because you don't know what they were willing to risk. You may not be willing to risk 20 standards on a trade, or 10 standards on a trade, or 15 standards on a trade. And instead, you can still be banking 5%, 9% on a Wednesday by 2 a.m. and, looking at it not just from a money perspective, but a percentage on year perspective. If you're in this for the long term, take a sip of my coffee. Oh, yeah, that's almost cold. If you're in trading for the long term, you don't want to be focused on, oh, well, I only made $100 this week or $500 this week. No, the real people that manage wealth look at it from a percentage on return. You hear people talk at the end of the year, oh, we did 20% on our portfolio for our investors this year. You don't hear them flexing a dollar amount. Think about that. So shift your brain, shift how you're looking at the market, how you're thinking about the market, and it's going to totally change. If you're looking at this on the long term today, just off our original position, banking almost 5% on a Wednesday, most 401ks are only going to get back, a good 401k is only going to get back like 12% to 20%, depending on this type of, is it a high risk setting, a low risk setting? So yeah, just something to think about. I got 24 seconds left. If you enjoy these types of markups, be sure to go check out the rest of the markups on my TradingView page, where we cover stuff just like this, and I'll catch you next market session. Till then, peace.